As evident in the thumbnail, this midcap fund has a 3-year CAGR, that is compounded annual growth rate of more than 41%. So, in today's video, we'll do a detailed analysis of this midcap fund, that is Motilal Oswal Midcap Fund, and try to understand that with such a good CAGR, why the fund is not very popular in the midcap segment and does not have a very high AUM. So, should you invest in this fund? Hello everyone, I am Dhaval and welcome to my channel DIY Finance. So let's start the video with the basic details of this fund. First, the AUM, that is the total asset under management, which is about 4,500 crores, which I feel is on a lower side as compared to other funds in its category. While the expense ratio is 0.76%, which I feel is a little higher as compared to other schemes. The benchmark index, that is the reference against which the scheme is compared, is Nifty Midcap 150 TRI. Now let's look at the sector-wise allocation. From the graph, it is very clear that the fund is heavily invested in technology, followed by automobile, services, chemical, and finance. When the sector allocation is compared to its benchmark, the allocation is quite different, especially for the financial and the technology sector. Too high allocation to a particular sector can lead to concentration risk and can dampen the performance of the fund if the sector does not perform well. Now let's look at the top holdings. As evident, Persistent Systems, Coforge, and KPIT Technology are the main stocks of the technology sector, whereas Tube Investments of India and Balkistan Industries are from the automobile sector, whereas Zomato is from the service sector. Here, the portfolio turnover ratio is 126%, which is quite high and indicates that fund has been making changes in the portfolio in a huge way or more frequently. So before checking the portfolio allocation, let's look at the major changes in the portfolio it has made in last 3 months. Firstly, let's look at the stocks it has added to the portfolio. Here if you see, Zomato and Coforge tops the chart as the new entrants in the portfolio with an allocation of 9% and 6.5% respectively. They have also added Persistent Systems and KPIT Technology stocks in a sizable quantity. 3 of the 4 top additions are from the technology sector, which is also evident in the sector-wise allocation, as technology sector is having an exposure of more than 21% in the portfolio. But will this high exposure in the technology sector will help the fund to outperform, or will it drag the performance down? Only time can tell. Now let's check the stocks it has sold in last 3 months. Here, Indian Hotels tops the chart, followed by Reliance Industries, AU Small Finance Bank, and Max Healthcare. Here, the fund has sold its total holding in the all above mentioned companies. Now let's check the portfolio allocation. Here, if you observe, mid-cap stocks form around 65% of the portfolio, whereas large-cap stocks form other 27% of the portfolio, and rest 7% is allocated to small-cap stocks. The higher allocation to large-cap stocks generally make a portfolio less volatile. Let's see this in the later part of the video, whether really the fund is less volatile or not. The portfolio is extremely concentrated as there are only 24 stocks and the top 10 stocks form around 63% of the portfolio, whereas top 3 sectors contribute to around 48% of the portfolio, with around 21% coming only from the technology sector. Here, the portfolio PE and PB are also on a quite higher side, which suggests the fund has most of growth stocks in its portfolio. Now let's look at the fund managers. Mr. Niket Shah has been managing this fund since July 2020, that is almost last 3 years. He has been joined by Mr. Rakesh Shetty and Ankush Sood in November 2022. Hence, the team of fund managers is quite young for the fund, and would be interesting to see how the fund has performed after Mr. Niket Shah has taken over as the fund manager. So now let's compare the returns. Firstly, the trailing returns. Here if you observe the long-term performance, that is 5 years and 7 years, the fund has an average performance and is able to beat its benchmark and category with a very small margin. But when we compare the short-term performance, that is last 3 years, when Mr. Niket Shah has taken over as the fund manager, the fund's performance is quite excellent and is able to beat its index and the category with a huge margin. Hence, from the trailing returns table, we can surely say that fund is able to generate quite a good return in last few years. Now let's also check fund's performance for this calendar year. As evident in the graph, the fund's performance has been quite good for the most of the period in this calendar year of 2023 and is able to outperform its index and the category. Now let's also check the calendar returns for consistency of the fund's performance. Here we have the data for last 8 years, that is from 2015 to 2022. The fund is able to beat its index and its category 5 out of 8 years, which does not make the fund very consistent in its performance. Here if you observe generally, after a year or two of outperformance, there is 1 year of underperformance. The year of 2021 and 2022 has been quite good years for the fund, but it has usually underperformed in 2020. The excellent 3 years and 1 year CAGR we are seeing is due to the performance of this fund in 2021 and 2022 and also in the first half of 2023. I feel that the main reason for the inconsistency in the performance can be due to its over-concentrated portfolio. Now let's also quickly check the rolling returns. Here we have rolling returns for the period 1 year, 3 year and 5 years. For 1 year period, the fund is able to beat its benchmark 60% of times, whereas for 3 years period, it is able to beat its benchmark 70% of times, and for 5 years period, it is 75% of times, with almost zero negative returns. Surely, this performance can be considered good, but not the best, and this ratios not reaching 100% of times is due to the inconsistency of the performance of this fund. Now let's see how the fund performs on risk parameters. Here we compare the parameters with the benchmark index and the category average. First one, mean returns, that is the average return in a year, which is 37.30, which is higher than both the category average and the benchmark. Here, higher the value is better. Second one, standard deviation, that is a tool to measure how much the returns is deviated away from the mean returns, which in this case is 15.10, which is less than the category average and the benchmark. Here, lower the value is better. Third one, Sharpe ratio, that is a tool to measure the risk adjusted return, which is 2.19, which is more than both the benchmark index and the category average. Here, higher the value is better. Fourth one, beta, that is the volatility of the scheme compared to the category, which is 0.84, which is less than the category average. Here, lower the value is better. Fifth one, alpha, that is a tool that measures how much better the fund has performed compared to the category. Here, it is 9.34, which is quite high than the category average. Here, higher the value is better. Here, on all risk parameters, the fund's performance is better than the benchmark index and the category average, which is a positive sign for a fund. Now let's see the upside and the downside capture ratios. The upside capture ratio is the measure of how the fund performed relative to the index during the period when the index rose. Here, the value is 104, which indicates that the fund outperformed 4% more than the index during this rise period. Here, higher the value is better and should generally be more than 100. The downside capture ratio is the measure of how the fund performed relative to the index during the period when the index has dropped. Here, the value is 47, which indicates that the fund declined 47% as compared to the index during the fall period. Here, lower the value is better. The upside ratio is good, while the downside ratio is still better. And it has been generally observed that over long period, the funds having good ratios have a potential to generate excellent performance. So now coming to the conclusion, what investors should do. But before concluding this video and suggest what investors should do, I would request all of you that as you have watched the video till now, it seems that the topic is of your interest. Hence, I would request all of you to hit the like button and also subscribe to my channel if you have not done till now to watch such interesting videos in future also. So now let's look what investors should do. First, the existing investors. As the fund's performance is good and is able to generate good returns, I feel there is no need for existing investors to worry and can continue their investment in this fund. The fund has not been that consistent in its performance, but last 2 years have been really good and one should ride this upward momentum. But keep a watch on the fund's performance, as the fund is having a very concentrated portfolio of around 24 stocks only, which can lead to concentration risk. Second, the new investors. They can surely think of starting a new investment in this fund, as it is having a good performance of late. But do keep in mind that the fund is having a very concentrated portfolio, which can sometimes play negative for a fund if few of the underlying stocks do not perform well, as the weightage of individual stocks, especially the top 10 stocks, is quite high and can drag down the overall fund's performance. Surely, the fund is having a low volatility, but the concentrated portfolio can make the fund quite volatile for a short period. One more thing that one should keep in mind is the turnover ratio of the fund, which is quite high, which indicates that the fund managers have a tendency of churning the portfolio very frequently. So, investors who are expecting a buy and hold strategy funds should also think twice before investing in this fund. So, investors who are not comfortable with short term volatility or churning a portfolio can look at other funds from midcap like Kotak, HDFC, SBI, and others. I would like to add that personally I do not have Motilal Oswal Midcap Fund in my portfolio and not planning to start investment in this fund as I already have my investment in other midcap funds. I will again try to review this fund after 6 to 7 months and check its performance. So stay tuned to my channel. Please subscribe to my channel if you are not done till now and also press the like button. Do check my older videos. Click the attached cards to watch the videos. Thank you.